For those of you who are new to this channel, Best of Us Investors, and I also have a Best of Us Agents for real estate people, the channel is, by my design, something that I want to be an interchange, rather than me just a talking head spouting off my beliefs and my research and my information. I want it to be an interchange. I want those of you who are interested in investing or interested in real estate to give input. To that end, this video is going to be two parts. One is response to several of your questions and insights, and the other part is a bit of how I pick stocks. And let's start with that. I have a number of criteria. The first one is I will not invest. I don't invest in stocks. I take ownership. And I think that's a distinction. I want to be an owner of some of the best companies in the world. Right now that's focused on the United States. I want ownership so that I can grow my assets as some of the best companies in the world grow their assets. So I don't look upon things as investing. I look upon me buying ownership. I'm not a trader. I don't want to play that game because there are people who are much better at it than me. And I compare it to a poker game. If I go to Las Vegas with a $10,000 buy-in and I sit down with 7 other people on a poker table, I'm pretty sure they're going to kick my ass. They're going to take my $10,000 and ask me to leave. So I don't want to play that game, also in the stock market, because I know there are people in the stock market who are trading on a per second basis with million-dollar computers telling them what to do. I don't have that. So I won't play that game. I am an investor who takes ownership. The other thing, as I say, I want them to change my life. I want to have a company that has shown a history of making good decisions and building a good balance sheet. Because we don't know when the next virus or the next war or the next whatever is coming, and they are going to have to endure it, whatever form it takes. And we are being tested at this right now. If you aren't recognizing the importance of this, as you see oil companies filing for bankruptcy, as you will see airlines filing for bankruptcy, as you will see hotel chains, movie theaters, you will see most businesses pay their rent on the first of the month. Most businesses pay their loans on the first of the month. Well, we just passed April 1st. Then they have a 30-day grace period. That 30-day grace period is right around the corner. And you're going to see bankruptcies and people seeking the shelter of bankruptcy happening in May, hand over fist. Then you're going to see the smart companies, the ones with the big balance sheets, coming in and buying the good companies with bad management for pennies on the dollar. I want to have ownership in those good companies. I want to have ownership in those companies who have a good balance sheet. Then I look at management, at companies that have a CEO, a president, a board of directors who are not responding to the hedge funds, who are not responding strictly to fill the pockets of the board directors and the officers of the company, but are building a company that makes profit, and it wants to grow that company. I read an article in the Wall Street Journal this morning that just really struck that home to me. It's about Facebook going and buying, it's spending, I believe it's $5.7 billion to buy a company in India. Now, if you don't know, the U.S. is Facebook's largest market. India is their second largest market. And so back in 2016, Mark Zuckerberg went into India and tried to create a program to provide free internet service out into the masses of India. To give you some comparison, the United States population is somewhere around 340 million people. India is 1.2 trillion people. But most of them don't have internet. And Mark wanted to go and invest in India and give them free internet because he saw it as an opportunity for Facebook. India doesn't like companies coming in and taking advantage of their population for the benefit of the company. So that was in 2016 he tried to do that, and he got turned down. Now he is investing with the wealthiest man in India, and the company name is something like JOBY Platforms. And this guy is in all kinds of different things, but he is also very politically influential. So I look at that as here is a company who has money, who is now going out and expanding their reach. And that's the kind of company I want to invest in. Now, I was asked by Brandon to look at another company called Cloudera. Cloudera is in the artificial intelligence field. They were an IPO, I believe, in 2017 at $15 a share. They're now trading for somewhere around $7 a share. And he said, with everything that's going to happen relative to 5G, relative to a response to the coronavirus, and how I believe that's going to change the medical field, and it's going to be driven by artificial intelligence, Brandon astutely said, is this an opportunity? So let's take a look at my research on Cloudera and see if you agree with my interpretation of what should happen or what I should do relative to Cloudera. Yesterday I received an email from Brandon, and Brandon asked me to look at Cloudera, a stock that he has some interest in. And I think the reason he asked me is because I've been touting artificial intelligence, and Cloudera is a startup that went public at $15 a share, I believe it was last year, and has shown some growth. In fact, showed a revenue growth of 47% this last year, up to $211.7 million. And he's asking me, is this a good investment? And so I went, and Motley Fool does a nice analysis of it here by Leo Sun, and it's April the 1st, 2020, so it's current. And what I read in this, and you can find it just by Googling Motley Fool and put in Cloudera, is their competition is Amazon and Microsoft. And as I go through and read the article, I see that they've shown some growth. They found a bit of a niche in that what they're doing is doing a combination of the things that Amazon and Microsoft do and offering it in such a package that is different than what Amazon and Microsoft does. And so they've found a place. They also have found a place similar to what Red Hat did, which was acquired by IBM last year. And what it looks to me like is that they are positioning themselves in a niche with the hope that one of the big three, IBM, Microsoft, or Amazon, will buy them. And that's admirable. That's certainly fine. Now, for me, again, my criteria for buying stocks is that, number one, they're going to change the way I live, and potentially Cloudera could fit into that they're profitable. They are not. Cloudera is not profitable, and they show good management. And that's where they kind of fall apart for me. As we go down here and we look at their profit, in 18, they lost 385 million. They improved that on and by reducing it to 192 in 19, and in 20 it shot back up to 336. And if you read this paragraph up here, what you find is that was caused by the fact that they had a in-stock a stock-based compensation expense surged 88% in 2020 and gobbled up 28% of their revenues. In other words, they took some cash they had from revenues and they rewarded their stockholders and employees. So they pushed it into compensation by giving their founders and their key employees more stock because, again, they're looking to be bought out. Now they're seeking either by issuing more stock or borrowing money, they're seeking more capital to make it through the current times. I wouldn't buy this stock. I look at this stock and say, it is a company that is engaging in a move to get bought out. I'm not astute in that area. I'm not astute in the software industry relative to artificial intelligence. So I look at this as a gamble. A stock that issued at $15 a share, I believe it was in 2017, and now is down to $7 a share. So the only reason I would see that somebody would buy it is they feel at 7 it could go to 15 or 20 and they could double or more their money. That to me is gambling because it could go to 0 as well, or it could go to 3. This to me is like going to Las Vegas and going to the poker table with a $10,000 buy-in and me sitting down adjacent to a group of professional poker players and thinking I have a chance to win at this. It's only a matter of time that they will take my money away from me unless I just get awfully damn lucky and I win a pot and get up and walk away. I wouldn't be welcome back to the table. So, Brandon, no, this is not something that I want to buy. But it goes as a good example of what you should look for in a stock relative to what your goals are and what kind of a investor or a trader or just a day trader type mentality. You got to make that decision. I have made that decision. I'm an investor. I invest in companies that change the way I live, that have a good balance sheet and show good management. Now, earlier this month, I openly said that I wanted to buy the big 6. The big 9 include 3 companies out of China. And so my emphasis has been to buy Google, IBM, Microsoft, Amazon, Facebook, and Apple. And I've gotten into 3 of the 6 I want. The last one I got into was, I best guess it was last week, or maybe it was the first of this week. I got into IBM. And Homer came across a video clip relative to IBM by a gentleman that I have spoken of before. He's one of the original employees of Facebook, and he did what I thought was possibly the best master's degree in business 2-minute education piece that I have ever seen. And again, it goes to what I was talking about Facebook and how you need an executive, and a board of directors of a company who is interested in making profits and then taking those profits and expanding, like I explained what Zuckerberg did in India. But I want you to listen to this. Homer, I'm going to take heed with his piece about IBM, but you must also recognize that he said the ex-president kind of took advantage of their profit situation. They have a new president, and that new president I have read and I have studied and found he's interested in reducing the world's carbon footprint. I'm interested in that. I think that is far-sighted. But watch this piece. I think it's extremely educational and insightful as to how businesses work.
There's an interesting fact, Scott, that you should know, which is that since 2009, the 500 companies in the S&P 500, so these are the 500 best companies in the world, they bought back $7 trillion of stock and or issued dividends, okay? That turned out to be more than 90 cents of every single dollar of profit that they made over the last 11 plus years. The federal government, as well as the Fed, between monetary and fiscal stimulus combined, have essentially transferred around $7 trillion now back to those said companies, as well as, companies slightly smaller than them. And I think why I was frustrated is that I just think that that kind of behavior makes no sense. And instead of being punished, it has been rewarded. And if you ask me why, here's how I would explain it. The job of a CEO, especially of a public for-profit company, is to be a fabulous allocator of resources. And there are only two kinds of resources that a CEO controls that matter. The first is human capital, right? The people that work inside of your company and the ideas that they have and the products that they make. And the second is financial capital, the money that you take to invest in great ideas, to protect for the future, to prepare for whether it's a pandemic or a shock or a recession or a competitor. And the best capital allocators become the best CEOs. So if you take a company like Facebook or Google, they're a very capital asset light business. So a lot of their skill is in picking great people. So take Zuck. He picked Sheryl Sandberg, he picked me, he put us in positions to build that business. He's a fabulous human capital allocator. On the other end of the spectrum, take Buffett. He has no human capital inside of Berkshire. It's all financial capital, but he is a fabulous capital allocator. Or you take Jeff Bezos, a case in the middle, where he has both of those two things. In all cases, great CEOs are great allocators of capital. When you do things like buybacks and dividends, what you are essentially saying is you are throwing your hands up in the air and declaring to the world, I do not know what to do with this money. And instead of deciding to save that money, to try to do M&A, to try to invest in R&D, to pay your employees more, these people have given it back in an open market purchase. Now let's look at that for a second. Why is that a stupid idea? Well, it's a stupid idea for two reasons. The first is that it disproportionately only benefits the executives and the CEO and the board, because those are the ones that disproportionately get most of the stock inside of a company. And it disproportionately benefits those specific hedge funds that were agitating for that behavior and activity, who take a short-term position and allow themselves to participate in short-term profits. And now what happens is the people that believe least in the company, i.e. the people that sell the stock, get rewarded. And then who's left holding the bag? The people that believe in the business. Let's take a specific example, Scott, and you can see how bad this is. IBM, over the last decade, has spent $140 billion on buybacks. This is a company with a $100 billion market cap. The last CEO found a way to oversee 24 consecutive quarters of revenue decline, and for that, was still able to compensate herself $100 million of stock-based comp. Now, you look at all of this kind of behavior and you can say, how is this supported? Why aren't all these companies trying to figure out how to be more resilient? And it turns out that the incentives were so skewed away from being resilient, it was only focused on short-term profiteering for the sake of the managerial class and the hedge funds around them.
Those are two pieces of information that I would not have had if you hadn't fed them to me. And now I'm sharing them with my audience, which is approaching 3,000 subscribers, and that translates to about 10,000 unique viewers on a monthly basis. Some of you don't subscribe. Please subscribe. Join our tribe. And again, I really mean this. Best of us investors, I want to be a tribe, a collection of like-minded people who want to learn from each other and share information about how to invest. I read the Wall Street Journal every morning. I search the internet every day, and I know Homer does that because he's constantly feeding me stuff, and I know a lot of you do, and I know I have a lot of younger investors who I want you to not be thinking about. I got an email, I don't remember who, Peter I believe it was, asked me what I thought about Nokia and Ericsson. Peter, if that's the right name, I know why you're interested in Nokia and Ericsson. They're both chip makers. They're both involved in 5G. But they're both under $10 stocks. And I know that's why you're interested, because you can buy more shares. And I believe Nokia is down now to about $3.75. And so you look at that and say, wow, if it goes to $7, I double my money. What's the likelihood of Google from going to 1,000, from 1,000 to 2,000? Probably not. But it's also not the gamble that Nokia and Ericsson is. There is a reason they're a $3 and a $7 stock. And that's because they don't perform well in their field. That there are other people like Qualcomm who I think are their direct competition. And that's another reason I don't buy them, because I just use the word I think. I don't know that business. Warren Buffett was best friends with Bill Gates and would not buy their stock because Warren said, I don't understand what you do. I don't understand your business. I understand Coca-Cola. I understand the railroads. I understand the insurance companies. And that's what I buy. And that's what Warren said. Well, Bill spent some time with him, and now he owns some of Microsoft. So that's what I want you to do. And I want you to become astute. I want you to be focused. I don't want you to be all over the ballpark. Because, again, you need to pick under 10 stocks, set up a Google Alerts on those 10 stocks, and just become an expert on them. And anytime anything happens relative to those stocks, you are notified the first thing every morning in your email from Google that this is what somebody wrote. This is what happened relative to the stocks that you want to be an expert on. Now you can compete. Because I will share with you, I was a financial advisor. I was one of the largest at one point I was the largest financial advisor within the Ameriprise system. I had over 2,000 clients. I didn't have time to study stocks. I know more about the stock market today than I did when I was a financial advisor. Barron's just came out in today's Wall Street Journal with a whole section on the best financial advisors and money managers in the United States. Okay, if they're the best, that means they're some of the largest. That means maybe they've got a whole staff of people doing what I do, but the problem is they do it for 90 stocks. You can't do it. If you're going to go to Las Vegas and play poker, you do not get on the blackjack table. You do not get on the roulette wheel. You focus on what you want to be good at. And this is not only in investing, this is in life. You focus on what you want to be good at and then let somebody else do the rest. But you become an expert. So, if you want to be an investor, if you want to take ownership in companies, I've got 6 of them. I'll vary a little out of that when I see an opportunity. But then I will study it, I will understand it, and then I'll buy it. And I don't buy on price.